Good afternoon, everybody. This is Joe Gordon with Gordon Asset Management. It's around noon on Tuesday, July the 14th, and this is our weekly market update. Before we begin, we always have to show the disclosures. We're not giving investment or tax or any other kind of advice. These are merely opinions and information to help, hopefully, all of us make better informed decisions. You can follow us on YouTube. You can also sign up for these updates on wealthqb.com. And on YouTube channel, you just have to go on youtube.com and enter Gordon Asset Management and search, and up comes our updates. I think most all of them are up there. So let's begin for the day. Coronavirus update, and it's highly political, controversial, as you hear all the criticism in the media and television about states that open too fast, states that are now closing, etc. But here's basically the facts. Let's look at this yellow orangish line. You can see new cases up 3.35 million total now, and that's not a good thing from some, but then from others, it's the logic. If you're testing more people, then obviously you're going to have more positives. So, I mean, it kind of goes with the territory. A lot of people say this is necessary for herd immunity, which Sweden obviously achieved. If you look at deaths, though, in the blue line here, it's trending way down. And this is what many of our medical doctor clients and also medical doctors around the country are very outspoken about, sometimes so critical of the messaging that they have their videos from YouTube removed. But at the end of the day, you can see the trend line on deaths is going down, 128,000 total, and so forth. So the percentage or death rate of the total who are testing positive, just under 4%. So to me, overall, that's actually positive. And okay, so if you look at this particular graph, what it really shows is that from the National Governors Association, states with stricter mask policies have seen reductions in week over week. So obviously, mandatory, excluding these two states, California and Texas, only 13% growth in COVID cases. Over in the far right, recommended but not required, 13%. And then when you see patrons and employees in certain businesses or only employees in certain businesses, you see higher growth rates. So clearly, wearing a mask does something. And I think most of us on the call know that the one place that you probably want to wear a mask in is a grocery store, even though no one hardly did it until maybe mid to late May. And many people were doing it, but it was not forced on employees in these stores until it's probably as late as early June. Okay, this is a busy slide, but basically it's talking about where is the growth. The surge in Latin America means global death toll is on the rise again, and you can see in these states, Latin America down here, and the increase, and it's all the spike in direction. Brazil's been kind of a ground zero. Mexico more now, and Brazil surging, and even the president of Brazil was tested and was positive as well. U.S. does make up 14% of the daily deaths. And when I hear people critical of that, I have to remind them we're the third largest country, I think, in the world, behind India and China, with China being number one, and you can't really trust their data. But obviously, there's a surge. So let's look at markets and how they're reacting to the COVID cases. It seems that no bad COVID news really is influencing certain parts of the stock market. So you can see through yesterday, Monday, July 13th, Europe, Asia, Far East, developed markets down just under 10% year to date. Emerging market equities down only just under 4%. And that is graphed in the orange graph. And that spike last week is China's stock market going to highs it had not seen since 2018, led by the communist government of China bidding up stocks and telling all their citizens to buy, buy, buy. So that explains that. And then you see also the purple is the MSCI EAFE level percent change. Obviously, the -9 is going in the right direction. And then lastly, bonds. Global Barclays aggregate bonds positive for the year, so that's good. So in the U.S. markets through yesterday, the S&P 500 down 2.5% roughly. NASDAQ up 20%. There's been a total disconnection with NASDAQ. It was down 2% yesterday. There's sell-off. People are realizing that they can't go parabolic to the sky, and it's led by the five mega techs, which we've talked about on this series from every week. For there to be a sustained rally from this sell-off, you have to have small caps participate, and you can see that the Russell 2000, which is the blue, light blue, has rallied some off the bottom, still down 16% year to date. And of course, the Barclays Ag Bond Index is up just under 7% year to date, which for fixed income investors, they're having a good year. Pretty pleased. So now looking at some other data, we've looked at this slide last week, but just wanted to update it again. If you look at the far right, you can see year to date, roughly down 2%. From a peak of being down 34%, which happened in just short of a month or right at a month, from February 19th to about March 24th or so, a little over a month. And you can see, in contrast to other bear markets over here, 2008, down 49 peak to trough, and then only recovered a little bit, but ended up the year down 38. And then back here in 2000, 2002, you can see sustained down every year, down 34 in 02, down 30 year 01, down 17. And that peak to trough was right at 50% for the 3 years. And that was hard to recover from. So in perspective, we actually have a lot to be thankful for this year. There was some pain, but it didn't last too long. And yet everything seems to be riding on opening up the economy and COVID cases. And the big issue now is whether schools are going to open. So let's look at through yesterday's sectors, because this is interesting to see where the money's been made this year. Again, year to date, if you follow across here, you can see it. I'm going straight at technology. That's where the money. Remember, technology, some of those technology-related stocks are now in what's known as the communications sector. So combine these two, pretty much you can see related technology, direct and indirect, up 21%. If you're in real estate, you're down just under 10% year to date, but only 1% for the quarter. So there's been a rally there. Healthcare is break even year to date, a little rally quarter to date. And again, quarter to date is July 1 onward. We're through 2 quarters. And then you see consumer staples up in this current quarter, not down all that much. Utilities, disappointing. You would think down only 9% year to date. It was worse. But still rallying. And now with zero-bound interest rates, we expect utilities and REITs to do quite well. In fact, I was looking at a REIT manager that we used yesterday, and they were up 16% in the second quarter off the awful lows of early April. And then you go to the far left, and you basically see financials still struggling. A lot of the banks are reporting today, and a lot of it's not good news. JP Morgan had record earnings, about $4.5 billion. But then they took a non-cash charge, I think, of almost double that, basically for bad loans. So basically, they're reserving for loan losses because they want to be able to release that it wasn't bad in future quarters when the economy normalizes. But financials have recovered. They were down 35% in Q2, so down only 22. But it's hard to make money in financials with zero interest rates. The worst is energy, down just under 40% year to date. And we've gone from a negative price per barrel and nowhere to store it in April to now the price per barrel is right at $39, $40 as we speak. So it's clear there's been technology and communication services are winners. What we don't show here is sectors, but we'll get to. You'll see fixed income's been a real winner. We look at style boxes. The purpose of this slide is simply to show you, no matter where you look, year to date, growth, large growth in particular, stomping value, plus 13 versus minus 16. It's the same in mid caps, plus 4.7 to minus 18.7, and so forth. And now moving over to valuations, we look at this always. You can see back here, tech bubble starts to burst, valuations come way down. In 07, financials led the way. They were about a quarter of the S&P 500 index in 07. They crashed to earth, and most of the banks had to be bailed out. They were basically insolvent, and valuations came way down. And then here's the secular bull tracing it up through with a little dip in 18 when Jerome Powell raised rates 4 times and basically blew the market up through 19 and then this year. So valuations are all over the place, but we are past the 25-year average of 16 times. One standard deviation is 19 and a half. We're at almost 22. But again, I've said this on every call. If you take the 5 mega cap stocks out of the S&P 500 and they compose right at those 5 stocks make up about 21% of the index. They're trading at north of 30 times earnings. The rest of the index is around 16 times. So not to worry all that much. And here it is, the top 5 versus the index. This is really the gap between it keeps getting bigger. The top 5 are now outperforming the other 495 stocks by more than 35%. So clearly there's a love affair by consumers with tech. And again, all these companies have great balance sheets. They basically are growing top line revenue for the most part. But there's a lot of debate out there whether this can actually, you can't grow these things to the sky. Sooner or later, the rest of the economy has to follow suit or something's got to give. And normally it's going to be stock prices of the big 5. So you see here in the orange line, the top 5. You see the rest of the S&P 500 index, -2. So, really not good in that case. If you look at Optimism Index, clearly it's up to really as high as it's ever been, going back to 2000. So enough to be said there is usually that predated the tech bubble bursting. I'm not sure the tech bubble is going to burst, but certainly when you see optimism, everyone chasing the same few stocks. If you've got them and they're winners, you might want to sell into strength and take some winnings off the table and buy them back 40% cheaper. I'm reminded for those on the call that own Amazon, it was trading at 2,600 in February, late February, February 19th or 20th. And then March 24th, it was trading at 1,600, 40% less. So that's the kind of peak to trough loss you can see even in a great company with over $1 trillion market cap. So now let's look at high frequency economic activity. And this just tells you if the recovery is really happening. So mortgage applications are up 33%. I mean, at zero bound rates, everybody's refining, but also a lot of millennials in particular decided to buy single family homes. They don't want to live on top of each other anymore and share common spaces because of COVID. So there's a lot of people leaving for the suburbs. Also, there's mass attrition out of places like New York City and all the big cities in the country, and people buying homes in suburbs because they want to pay the exorbitant rent. So you see that. You see seated diners was down 100%, now it's down 60%. So that's an improvement. But obviously a restaurant that can only seat 25% or what they were before has to keep relying on deliveries or takeout for their survival. TSA traffic was down almost 100%. Now it's down 72%. And I think last week I heard there was like 700,000 people went through TSA. And I think at the low it was under 100,000, like 85 or 90,000. Driving direction usage way up. Global flights way improvement from -64 to -20, but still down. And even hotel occupancy down 70%, now down only 30. So clearly things are getting better, but they still aren't anywhere where these companies can remain solvent for very long. So let's look at continuous claims for unemployment. And you can see here in the purple, continuing claims for unemployment insurance is trending down. That's a good thing, but still 18 million plus. You can see initial claims is trending down from the peak, from up just under 7 million or so down to 1.31 million last week. So it's down from its high, but clearly there's a lot more pain to come. A lot of the airlines are talking about furloughing people permanently after their bailout money ends September 30th. Many of the banks are going to be reducing jobs. The rumor on the street with Wells Fargo is they employ 263,000, and they're going to lay off 10% of their workforce, or less those who take early retirement packages. So a lot of white-collar employees are going to see what unemployment feels like in the coming months. So this hasn't gone away by any stretch. Job postings are falling, and this is interesting because right before the crash, they were up here up 10%, and now since then you can see the trend line. It's actually going down, and in some cases it's just the jobs are not coming back. Number one, and others, is companies are realizing they don't need or want as many employees as they had previously. And probably the unintended consequence of the stay-at-home economy is that many people really embrace digital banking, digital technology, digital everything, digital business presentations. And so a lot of folks feel like you don't need to spend money where you used to. Now let's look at recession. So the Great Recession, we had a 27% decline in GDP. The depression, I'm sorry, called a recession back in the 30s. You can see that, and here we are over here, 12%, 13% almost in GDP decline, and that's not good. So clearly, we're chasing after the second worst one of all time over here, post World War II demobilization. So we really not out of the woods yet, and again, that's why there seems to be such a disconnect between Main Street and Wall Street. If you look at consumer finances, we looked at this last week. The good news is the consumer's in better shape than they were previously. Over here in the far right, household net worth is still trending up from back at a peak in '07, down and then trending back up as far as net worth and U.S. dollar and billions. And then you see over here household debt service ratio, which is more important, is basically much less than it was at the peak going into the financial crisis. So the balance sheets of the consumers are much better. Their net worth is much better on average, and that's good news. And the reason that's good news is that GDP, consumer consumption, makes up about 70% of our GDP. And here it's just showing the composition of assets on the consumer balance sheet, homes being a quarter of it, pensions, other financial assets, about 60% of it. And then on the debt side, you can see student debt is a sizable part of it, but most of the debt is mortgages. So now looking at corporate debt, U.S. debt to GDP ratios, that's the government, gray line. We're over at 100% now because of all the Fed liquidity. Generally when that happens, that does not bode well for future economic growth. Household debt to GDP is actually way down from a peak in the financial crisis. So again, consumers have gotten their act together in general, and then non-corporate financial debt also in pretty good shape. If you look at certain duration of investment-grade corporate credit is average 6.2 years, but it's up a little bit. A lot of companies are actually borrowing a lot of money just to buy them time to get through this. Now let's look at where our debt is relative to the rest of the world. So if you look at negative yielding debt, you can see here there's a spike in it. Japan is purple, Europe is the dark blue, and total corporate debt. So coming over and really looking at it on this bottom right graph is probably the most interesting. It's basically yields, the U.S. 10-year is right at 0.64. The U.S. 30-year is at 1.32 or so. And if you look at average cost of government debts by yield, it's really money is cheap. If you look at negative yielding debt, you can see below zero, there's a good bit of it, and then below 1%. So really in the world, everyone is at zero bound interest rates and money printing. So fixed income usually benefits from that. If you look year to date, being in safe U.S. Treasuries, you're up 9%. If you're in long dated Treasuries, 20 to 30 year, you're up 25%. If we're in gold and gold miners, you're up 25%. But in fixed income, it's really been safety, the government Treasuries tips, which are government Treasury inflation protection securities. And then even in quality intermediate corporate debt, the Barclays Ag up 6.7, corporate debt up 6.5. So clearly it's been a good year for people in fixed income. And the only place in fixed income it hasn't been good is anywhere here at the bottom you're taking credit. Emerging market debt, high yield debt, negative. So an emerging market debt, that's local currency versus U.S. dollar. The dollar's been strong, but many say it's starting to weaken. All right, trending up in the last few slides again. Time diversification and volatility. Clearly, the most volatile asset and own over a 1 year basis are stocks. You can hit a home run. You can also strike out. Um, the average return, though, over the last 20 years has been 11.3% average annual. Bonds has been half of that at 5.9. A balanced portfolio in the middle at just under 9% a year. But clearly, you can see volatility. It's all stocks on a 1 year. But as you hold them long, the volatility or variability in returns shortens a good bit. You see that here with 10-year rolling. So staying invested, there is a lot to it. Those that sold in late March and early April are regretting it because of the sharp snapback rally. Again, reminding everybody about these returns by asset class. The last 20 years, REITs has been, real estate's been the best place. And that's why we like to see 10% at a minimum of real estate and client portfolios. And you see here, gold has actually beaten the S&P, and a lot of people don't believe that. But the reason is gold was at $200 an ounce going into 2001. Stocks were at all-time highs. You had the tech bubble burst, the financial crisis, and now this recession that we're just in. And so that's three big market losses. So you can see that over time, clearly a balanced portfolio is 40-60, conservative 60-40, a little more aggressive, compounding at just mid 5% range. The average investor, because of emotion, only 2.5%. So that bodes well to stay invested or hire an advisor to caution you from jumping off a cliff at the worst possible time. So that's it for today. Quick update, and we look forward to any questions any of you have. By all means, feel free to reach out to whomever you work with in our firm, and if you are not a client of the firm, you can email us at info@wealthqb.com. We'll be happy to entertain your call. Thanks, and have a super week.